Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is January 8th, 2025, second week of the new year. I'm going to begin with the dashboards showing you the stock market indexes. These are 6 equity indexes and 1 bond index. So the 4 of those are U.S. equities, Dow, S&P, Russell, and NASDAQ, and 2 foreign markets, the developed markets and the emerging markets. And this shows you year to date, so this is 2 weeks worth, or less than 2 weeks worth. So this shows you the week, for the past week, where things are, and where the year-to-date number is. They're both pretty similar, but you can see that on the year-to-date number, all 6 equity indexes are positive already for the beginning of 2025. And bonds are down again. They were down a lot last year. So if you are in a traditional 60-40 buy and hold portfolio, you are probably having anemic returns. And by the way, not all equities are going up. I mean, we've got certainly the Magnificent Seven, and the NASDAQ is going up, but you've got a lot of old economy stocks. The Dow, the old economy index, not doing as well as the S&P, and certainly not as well as the NASDAQ. Small cap has been up and down, but it also is not doing as well as the large cap growth. So, but for the week, you can see they were 5 out of 6 were positive. Year to date, all 6 were positive, and in both scenarios, bonds were negative. And when you go across the bottom, again, bonds negative with the 50-day, 100-day, 200-day, 20-day moving average. When we take the S&P 500 and break it apart into its component parts, you see the 11 sectors. The yellow box shows the last week. There's one thing that stands out here for sure. Well, maybe a couple. But the one thing is energy. Energy is up 4.5% for the week. That's a lot. And the consumer staples down 1.25%. Again, a lot for a week. Year to date, energy again is leading with over 3%. At the very bottom, consumer staples is negative, slightly negative. And in the red-green dots, indicators, indicating is it above or below its 20, 50, 100, 200-day moving average, there are 18 out of 44 green dots compared to 16 last week. So it's it's mixed. There's positive and there's negative. There's certainly plenty of positive. S&P 500, this is a line chart showing the last 30 months, so 2.5 years, where has the S&P been? Going up, and you can see at the very far right of the chart, it's continuing to rise above its 20 period moving average. When I put that on a candlestick chart, you can see that, again, same thing, except when you see the hollow candles with candlesticks, they represent more of a period of gain, and the red ones represent more of a period of losses. To me, it seems very overextended, but it keeps going, and it will keep going as long as it does. Having some kind of method to deal with it when it begins more of a major descent down, that's more of a strategy. But for now, it's just, I think of it as having a foot on the accelerator and a foot on the brake. I'm personally prepared to get out when that time is appropriate, but each person's got to decide what kind of method they want and how they want to approach it. Okay, this is a comparison. This is a relative strength. It's comparing the NASDAQ 100 to the S&P 500. The NASDAQ 100 is a growth tech-heavy index. And when it goes up, it favors the numerator, which is the NASDAQ 100. When it goes down, it favors the denominator, which is the S&P 500. So far over this period of time, again, it's a 30-month chart, so for about a 24-month period, generally speaking, the NASDAQ growth stocks has been more in favor than the broad market. This takes the S&P 500 and splits it into two parts: growth stocks, or growth ETF, and value stocks. And when it goes up, it favors growth stocks. When it goes down, it favors value stocks. It's done some of both. Currently, when you see to the far right of the chart, you can see that it has gone up a lot recently, and that favors growth. So from the beginning, for that 2 year, it's a 2-year chart, so that 2-year period, it has definitely been, growth has been more in favor, which means that relative to growth, value is down, and so the broader market is not the Magnificent Seven or the top 10 or the top 20 or whatever. It's 500 stocks that represent the entire type of the economy. And many of those have not been doing that well. But you don't see it when you look at the NASDAQ or even the S&P 500. You have to kind of look beneath that. And this kind of gives you a clue that a number of them are not doing that well. The S&P 500 compared to the small cap ETF IWM, again, same thing, and S&P is the numerator, small cap the denominator. When it goes up, this is favoring the S&P 500. When it goes down, it's favoring small cap. Long-term government bond. Now, the earlier chart on the dashboard on long-term government bonds does not illustrate this because it just captured year-to-date, the last week or two. But you can see for the last 5 years, the direction of long-term government bonds. And by the way, if we were to say intermediate-term government bonds, IEF, or even AGG, bonds in general are down. Now, each chart looks a little different. I use TLT because when they go up, this gets the highest gain. But when it goes down, usually this has the biggest losses. So, but it tells you the direction of bonds in general. So yeah, to the far right of the chart, they're definitely down and weak. What does that tell you? It tells you that interest rates and bond yields, both correlated, are going up, or the perception is they're going to go up. And as such, there's more sellers than buyers of bonds. The dollar 4-year chart, most of that 4 years you can see is going up. And at the very far right, it's pretty extended up there. It's the dollar is strong. What that means is that people in other countries or other currencies, their money doesn't go as far when they're buying or investing in the U.S. Conversely, people in the U.S. with U.S. dollars, when they're investing or buying things abroad, those are, the dollar goes further. Gold, kind of a lackluster week last week. It's a 30-month chart. Most of that 30 years, you can see that gold has gone up. Silver, also going up, and it's more volatile, but it's been up and down, but in general, it's been up. Bitcoin has been doing quite well lately. I think in the last, 4 or 5 months, Bitcoin has been doing very well, and this is a 30-month chart showing how it has been doing, including a gain for this past week. Volatility index. Now, this looks like a lot of noise going up and down and up and down. And at the very end of the chart, you can see that it's kind of stable for the past week. But that tells you that the market has been for the last, this is 2.5 years, well, it's actually 3 years, has been going up and then down, up and then down. In the market, volatility, the downward side of the market, downward volatility, is expressed with spikes that go up. And there's been a lot of that. So it doesn't mean all equities are going down when that happens, but it's an indication that there's an indecisive market and a market that's kind of leaning this way and then it leans that way. Back and forth, back and forth. We've seen some of that. Asbury Research does the metrics for the Asbury 6. 4 of them are still negative. 2 of them have turned positive. They were all negative last week. And so this, generally from their view, if there are 4 of them, that they consider that still a negative view of the market. Cross-asset relative performance, comparing one asset class or type to another. So, for example, and I look at ones that are the last week, the last month, the last quarter. High beta, high volatility stocks have been more in favor than low volatility, low beta stocks. The broad market, the S&P 500, has been doing better than the narrow market, the blue chips, the Dow Industrial 30 stocks. The broad market, the tech is doing better than the broad market. So broad market better than the Dow, NASDAQ better than the S&P. Growth stocks, as I showed you on the previous chart, doing better than value stocks. U.S. is stronger than the emerging markets and the developed markets in all 3 time periods. High yield is better than high quality. And in other words, you could say junk bonds are better than government bonds from the standpoint of strength or growth. Short-term better than long-term bonds, government bonds. Okay, the U.S. versus the world. There are 25 different countries or regions in the world illustrated here, comparing the U.S. equity market to those equity markets. This is not the currency and this is not the economy, but it is the market. So not a single one is doing better than the U.S., and the U.S. is doing better than Chile, Brazil, Peru, Mexico, Switzerland, Italy, Germany, France, UK, Eurozone, Japan, Hong Kong, Singapore, China, Thailand, the Pacific, New Zealand, and all the emerging markets, or the emerging markets as a category. So the U.S. market is strong in relative terms, relative to others. And I'm showing you this, the U.S. dollar is strong relative to other currencies. So interesting. We're in a good position from that standpoint, but it tells you that other countries and other currencies are struggling. I've taken South Korea as an example. It's a good example because it's a consistent chart. The chart goes, generally speaking, in an upward direction for most of that 4-year period of time. So it tells me that South Korea is struggling as far as a stock market, and it tells me, of course, that the U.S. is strong. It is so much stronger than South Korea that it causes a chart to go like that on a relative strength basis. Gold and silver, as of Friday, the spot price of gold was $2,640. Spot price of silver, $29.72. Both have slight increases from the previous week. The gold-silver ratio is 89 to 1, meaning gold is 80 times more expensive than silver. That favors silver as a better buy because it's undervalued. A monster box is 500 rounds of silver, generic rounds. And that is $15,695 as of Friday. And that includes a $1.07 per ounce markup over spot. And the cost per round, including the markup, is $30.79. And I thank Preston, my son, for providing me this information. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.